The last model is a net investment, a hedge on a net investment in a foreign operation. So when we think about net investment, we're talking about really the equity that exists in that particular foreign subsidiary. Now, the foreign subsidiary has to be in a different currency than the US dollar. So we're going to come up and discuss functional currencies, et cetera. But for this moment, at this stage, we're just going to be suggesting that our net investment in that foreign subsidiary, and that doesn't have to be 100%, but our net investment in that foreign subsidiary should be in a different currency than the US dollar. We're assuming that everything is going to be reporting currency in the US dollar. So we're here on the FASB site. We just want to make sure that we have an idea where we're looking for this particular item. Again, derivatives and hedging, and we're looking at net investment hedges, right? So this is just how we are investing in a second separate subsidiary. And we'll take a look at just our subsequent measurement. This is where we want to go because recognition of whether or not you qualify for a net investment hedge is really covered in the overall hedging discussion. So we'll take a look at subsequent measurement, and we'll look at the very first statement that, again, we're talking about net investment we're hedging a net investment in a foreign subsidiary using a derivative instrument. You can also hedge a net investment in a foreign subsidiary with on-balance sheet items, but that's covered a little bit differently. But we're just talking about the derivative instrument. And I'm just going to read this 35-1 to you. So the gain or loss on a hedging derivative instrument, okay, or foreign currency transaction gain or loss on a non-derivative hedging instrument. So either one, whether it's derivative or non-derivative, the foreign currency gain or loss that is designated as and is effective as an economic hedge. So whether it's a derivative instrument or a non-derivative instrument, is designated as an effective as an economic hedge of the net investment in foreign operation. That's our piece, our equity piece. Shall be reported as in the same manner as a translation adjustment. That is, it's going to other comprehensive income to the extent that it is effective as a hedge. Now, this language right here that we're talking about, to the extent that it is effective, is being replaced. This is the new literature, okay? It does not have this definition, right? So if you take a look at the transitional information, that statement, to the extent that it's effective as a hedge, is now gone, right? It just says will be treated as a translation adjustment, right? So the whole idea of the effective piece is going to other comprehensive income, so therefore the ineffective piece goes somewhere else. That is something that you will not face because you can see that the transitional guidance has already been in place for years ending after December 16th, 2018 for public companies, and will be in place for years ending after December 16th, 2020 for non-public companies. So this is going to transition to brand new literature. So let's just get a little bit more detail on what we're thinking about with this particular discussion of a net investment hedge. So we're talking about, and again, this can be on balance sheet or off balance sheet. We're focusing really on the off balance sheet or the derivative contract. So a net investment, a hedge of a net investment in a foreign subsidiary. Okay, so in this particular case, we are assuming that, and this could be a investment in a foreign subsidiary where we are using the equity method. Of accounting. Or we own enough of it, and this is, remember, if you recall, we had this discussion, we have some kind of influence, and or we own anywhere between 20 to 50% of the foreign subsidiary, right? We would tend to use equity method accounting there. So this would be the equity method accounting, that would be our net investment. Probably, and there's some literature specifically in here that talks about equity method accounting versus the next one, which is we own 50% or more and we are consolidating the entity. This is really where we're going to be spending most of our time. There is literature out there that says we can hedge this equity method investment, but this is, when we consolidate, it's 50% plus as far as our ownership in that organization. So when we think about net investment, right? Net investment or net assets. Right? It's our ownership percentage of the organization's equity. That's what this refers to. And because this investment, these net assets, are all in a functional currency, in a currency different than the US dollar. So it's in a foreign currency. We can hedge the FX risk for this particular foreign currency. We don't have to hedge a specific asset or a specific liability or combinations, right? We don't have to do that. All we know is that we have the net assets are in a foreign currency. There's foreign exchange risk relative to the US dollar. And so we can take all or a portion of the net assets that we own, right? Again, it's whatever our percentage of equity, whatever the percentage of net assets that we own, we can hedge 50% of it, we can hedge 10% of it, we can hedge 100% of it. We can't hedge 110% of it. But we can hedge a portion of this and identify which portion that we want to hedge. So we can put on a foreign exchange forward, we can put on a foreign exchange option contract, or some kind of cross-currency swap, whatever makes the most sense, determine whether or not it's effective or ineffective, both prospectively and retrospectively, make sure it's all documented, and then any of the changes, as we pointed out, any changes to the derivative, right? We're talking about a derivative here. The derivative is treated the same way as translation adjustments. And those translation adjustments go through OCI. And we'll learn more about translation adjustments, remeasurement, all of that stuff in the next couple of modules when we start talking about foreign exchange risk.